Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance studios in London. It's Monday, 10th November. Coming up on the show, earnings season continues with the likes of Walt Disney, Cisco and CoreWeave taking centre stage this week. Quantum computing stocks are on the rise again in the pre-market, but with gains of more than 1,900% in the past 12 months, is it too late to invest? And perhaps there are signs that the government shutdown could be coming to an end. The president certainly thinks so.
Looks like we're getting very close to the shutdown. We'll never agree to give any substantial money or any money to really prisoners, illegals that come into our country. And I think the Democrats understand that. And it looks like we're getting close to the shutdown ending. You'll know very soon. Thank you very much.
Well, last night, a new bill to end the government shutdown was released and then quickly advanced by the Senate. The tally of 60 to 40 saw 8 members of the Democratic caucus join with Republicans and was just enough to overcome the Senate's filibuster threshold. The key vote is now expected to enable the chamber to pass the bill soon, after which it will move to the House of Representatives. The bill will keep the government open until the end of January and put limits on Trump's ability to fire federal workers. The news sent markets across the world higher, and Wall Street also looks set to open in the green. Also on Sunday, US airlines cancelled more than 2,700 flights with more than 10,000 flight delays. The Transportation Secretary, Sean Duffy, warned that air travel would slow to a trickle if the shutdown lingered into the Thanksgiving holiday season. And remember, White House economic advisor Kevin Hassett on Friday said that the economic impact of the shutdown was far worse than expected. So this latest development is certainly being welcomed on a number of fronts. Well, one thing that's been missing has been official government data. Here's the University of Michigan's Betsy Stevenson on the impact that's having. She was speaking to my colleague, Julie Hyman.
Time now for what to watch. Going to start off here on the earnings front. Got another big week of reports, including CoreWeave, Paramount, Skydance, and Walt Disney. Disney is going to be announcing results for the fourth quarter ahead of the open on Thursday. Analysts expecting a solid Q4 for the company, driven by strong performance in its parks business, despite competition from Comcast's new Epic Universe theme park. And taking a look at the Federal Reserve, big batch of Fed commentary coming up with at least 8 officials set to speak. This is coming after comments from Fed Vice Chair Philip Jefferson on Friday, when he said the Fed should proceed carefully now that rates are closer to a neutral level, one that neither slows nor boosts the economy. And checking in on small businesses, the NFIB Small Business Optimism Index is coming out on Tuesday. Economists forecasting that number to fall slightly to 98.4, signaling small business owners are feeling slightly less confident about the economy. And finally, we're nearing a big day here at Yahoo Finance. It's our annual Invest event on November 13th, starting at 8 a.m. Eastern. We've got a full day of live global coverage of the key themes driving the market, AI, crypto, and a whole lot more. We're going to be talking to industry leaders like Strategy's Michael Saylor and Palantir's Alex Karp about those mega trends. We won't want to miss it.
We can't pretend that we're not missing data, because the federal government data that we're missing is a really important piece of this. It's great that we have the ADP data. Keep in mind, ADP is a huge business. They have almost 500,000 companies that rely on them for payroll processing, which is why they can cover, give us information on what's going on in the labor market. About 26 million Americans get their paycheck processed through ADP, and their data tends to be correlated but not perfectly predictive of what we would be getting from the BLS. And what we're seeing from ADP is we have ongoing job growth, but it is much, much slower than what we had before. And then we're putting this in, together with data that says that we're seeing a pickup in some amount of layoffs. I don't know how much stock I would put on that just yet. I think what we're seeing in the labor market is a labor market where hiring has dramatically slowed. So if you have a job, great. And I don't think that there's a ton of risk that you're going to lose it. But if you do lose it, you're kind of in more trouble than you would have been, say, a year or two ago, because we're not seeing a lot of hiring. And so it's going to be harder to find that job. For sure, what we've seen in the last 6 months is a decline in the dynamism of the economy, meaning there's a slowdown in businesses forming, businesses hiring people, and all of that leads to a slowdown in the labor market.
And we do have, in terms of data, we have the weekly unemployment benefits coming from the states, right? And that, again, doesn't show us a lot in terms of clarity in what's going on. And in any case, that's more on the losses side of the ledger, not the hiring side of the ledger that you're talking about. But, you know, the stuff that we do have like that, what is that also telling you about sort of labor market demand out there?
Well, you know, we always see that some people lose their jobs. And it can be very hard in those weekly claims without a longer time series to really see, are we really seeing a pickup in layoffs? As I said, I think there is some suggestive evidence that we're seeing a little bit of a pickup in layoffs, but not one that I would necessarily say is makes it time for us to panic. I think the bigger problem for American consumers, as they're taking a look at what's happening around them, the labor market's slowing down, so it's harder for them to find a new job, maybe to get that raise that they want, to make a transition. They're at a slightly increased risk of losing their job. And they're going to the grocery store, they're shopping for, maybe getting that early start on shopping for Christmas, and they're seeing higher prices. And you put that all together and nobody feels good about that. You know, rising inflation and a slowing labor market is a recipe for a really uncomfortable economy.
And that was Betsy Stevenson from the University of Michigan. We also heard earlier from Josh Lipton on what to watch this week as well. That brings us nicely on to the 3 things you need to know. Well, the first thing you need to know is that Pfizer has clinched a $10 billion deal for obesity drug developer Metsera. The US pharma giant had been in a bidding war with Danish rival Novo Nordisk. Now, Metsera accepted a sweetened offer from Pfizer late on Friday, leading to Novo, the maker of Ozempic and Wegovy, withdrawing from the race on Saturday. Now, shares of Novo surged in early trade in Europe. Now, the next thing you need to know is that China has ended export restrictions on Nexperia chips. This should help relieve supply shortages for car makers and automotive suppliers. Now, Nexperia makes chips used in automotive electrical systems. This is perhaps a signal from Beijing that will ease pressure on the global car market, which has been hit by these export curbs after the Dutch government took control of Netherlands-based Nexperia, which is actually owned by China's Wingtech. And the last thing you need to know is that earnings season continues this week. The third quarter earnings season does slow following the second busiest week last week, with 9 S&P 500 companies scheduled to report. Now, with 91% of companies reporting so far, 82% have beaten consensus earnings estimates. There are still some notable names reporting this week: Cisco, CoreWeave, and as you heard earlier from Josh, Walt Disney. Okay, we're heading for a short break now, but stick with us because when we return, Russ Mould will join us from AJ Bell to take a closer look at whether worries over an AI bubble are justified. Welcome back. Well, AI is on everyone's minds, and worries of a bubble knocked more than $1 trillion off the value of a handful of the biggest AI-related stocks last week, including Nvidia and Meta. The increasing sense of panic about the valuations of Silicon Valley's big shots as they splash out unfathomable sums of money on AI infrastructure was largely to blame for the rout. But signs of weakness in the US economy didn't help. But this morning, those big players are firmly in the green, led by Nvidia there, up about 3% in the pre-market. So are fears of an AI bubble justified? Well, to help answer that, I'm joined by Russ Mould, Investment Director at AJ Bell. Russ, thanks so much for joining us. Well, let's start with that question. Are these worries justified about an AI bubble?
Well, you're probably asking the wrong person, because I'm not sure I'd have predicted that the valuations would get to where they are at the start of the year. So that they've already made a fool of me once. You can understand why the concerns are there. Valuations do look lofty on conventional metrics. You can certainly see concerns gathering over some of the circular nature of the fundraising that these companies are going, and questions of where does OpenAI get its $1.5 trillion from? And also, even in terms of the companies that seem to be particularly well positioned right now, say Alphabet, for example. Alphabet, Amazon, Meta, these companies are now moving from being very asset light to potentially very asset heavy businesses because of all the building that they're doing. And also they're now starting to encroach upon each other's competitive patch. So you are seeing some different dynamics there, ones that may challenge, at least raise questions over those lofty valuations, which they seem to deserve at the moment.
And we'll get a bit more sort of clues about where AI is going. We hear from CoreWeave after the bell tonight. What are you hoping for?
Yeah, I think, again, what you've been looking for there is the company talking about backlog, talking about visibility, and talking about pricing. And I think those will be the issues that investors will be focused upon. And again, any signs of any weakness in demand won't be taken very well. Any signs of extending backlog and strong visibility, I'm sure will be taken positively. But, as somebody who was around in the late 1990s as a technology equity analyst, the one thing you always need to be careful of is when you have companies saying we're sold out for the next 2 years, the market might just start to think, well, if it's that good, it can't get any better. And if it can't get any better, then one day it might start to get worse. And that was one of the sort of early tipping points in the TMT bubble in the late 90s. So watch out for that one.
Now, we'll be talking a bit more about NVIDIA later in the show as well. But it's also, had that issue with China, with Blackwell chips. How do you see this all playing out?
Yeah, I mean, Jensen Huang was very clear with his guidance for the quarter that there was no attempt to include any benefits from Chinese business in the period. We've already seen them take a big write-down earlier on in the year. And the summit that we got between President Trump and President Xi in South Korea at the end of last month, it seems to be enough to keep President Trump happy and indeed President Xi, but there wasn't anything that tremendously conclusive came out of it, apart from a reduction in the tariffs from the US, soybean agreements, one or two others. Technology still seems to be a pressure point between the two superpowers, and I suspect that may remain the case for some time.
I suppose you'll be watching their results next week very closely indeed, Russ. All right, let's move on to President Trump and this $2,000 dividend. What did you make of that?
Yeah, it's interesting. I mean, cynics will say, well, the timing's intriguing after a week of some poor election results, the ongoing government shutdown, a bit of a wobble in the stock market, and that terrible University of Michigan consumer confidence number right at the end of the week. Equally, supporters of the president will say, look, this is all part of the master plan. We're looking to run the US economy hot. We're looking to get interest rates down, keep the oil price low, deregulate, cut personal taxes, and get growth going. So they'll say it's all very much part of the master plan. And it's evidence that maybe tariffs do work after all, though I think the jury's probably still out there.
But the news of this $2,000 dividend is certainly having an impact on markets, certainly crypto and in gold, right?
Yeah, you can see gold and crypto prices nudging higher. You can also see US 10-year Treasury yields nudging a little bit higher. So yes, economy run hot may be positive in one way, but it does keep the inflation vigilantes worried in another on the other side of the coin. And again, that's why for those sort of haven assets or store of value assets are having a bit of a run as well. But I'm sure the S&P 500 won't be too upset about the prospect of a hot US economy if indeed that's what we get. So
where does that leave the Fed at the end of the year then?
Yeah, they'll be looking at this again, probably slightly through parted fingers, particularly given that they're still slightly data blind as well. I mean, the market is at the moment, perhaps you can argue, having its cake and eating it, looking for hot US economic growth, but still further interest rate cuts. The two don't necessarily sit together that well. So ongoing policy dilemma for the US Federal Reserve, at least until Mr. Powell steps aside next spring.
And if he does step aside next spring, where do you see the Fed policy going beyond that then? Are they going to do pretty much what President Trump wants, or do you think they'll still have that level of independence?
Everybody would like to think that they have that level of independence. I think one of the reasons why the US dollar wobbled a little bit at the start, in the middle of the year, and indeed American equity asset did as well, was some concern over that loss of independence. So I think that would be very much what markets want to see. Equally, rate cuts generally go down pretty well. So again, markets may be able to have their cake and eat it, providing inflation doesn't boil over.
Russ Mould from AJ Bell, many thanks for your thoughts and joining us here on Yahoo Finance. Okay, we're going to be heading for a short break now, but stick with us. We'll be taking a closer look at quantum computing stocks. It's time now for today's trending tickers. Well, let's start with chips. Nvidia isn't the only chip stock doing well today. Look at TSMC. The chip maker is in focus this morning as it released revenue numbers showing plus 16.9% year-on-year growth to around $11.86 billion. Sure, it's significant growth, but also it's worth noting it's the slowest growth in 18 months. The New York stock is up more than 2.5% in the pre-market, as investors acknowledge that clearly TSMC has pricing power and is key global player when it comes to chip supply chains. The thing is, TSMC is facing so much demand, it can't expand its production capacity fast enough. Nvidia CEO Jensen Huang, obviously a major customer of TSMC, says his company has asked TSMC for extra wafer supply as its next-gen AI chip demand surges. Well, on to a very different stock, Beyond Meat. The meme stock continues to see wild swings and its earning drama Beyond is there. Beyond Meat is under serious pressure. It is finally reporting earnings today after postponing its report last week, and the stock is soaring now on expectations ahead of the company's third quarter results. This is obviously a speculative and high-risk trade. The company's ongoing financial issues amid weak demand for plant-based meat haven't gone away. Well, our next ticker is Diageo. On the London market, shares of the maker of Guinness beer and Johnnie Walker whiskey jumped 6.6% on Monday morning after the company named Dave Lewis as the firm's new CEO. News of Lewis's appointment comes just after Diageo reported flat organic net sales in its first quarter and cut its sales and profit forecast. Now, Lewis faces a challenging task as alcohol stocks continue to suffer amid changing consumer habits. Finally, flagging one stock that is rising sharply in the pre-market, Rumble. It's jumped nearly 30% at one point this morning. Rumble is the video platform hosting President Trump's social media platform, Truth Social, and it's buying German AI cloud company Northern Data. According to media reports, it's a roughly $767 million deal that involves Nvidia chips and the stablecoin company Tether, which currently owns about 48% of Rumble. There are many other tech stocks in the green this morning. Keep a close eye on Yahoo Finance to stay on top of today's big moves. Now, quantum is having a moment. Small cap names like Rigetti and D-Wave have exploded. Stock gains have been as high as 1,900% over 12 months. That's according to Bloomberg calculations, outpacing many AI high flyers such as Palantir, even as revenues remain tiny and volatility extremely high for quantum computing. So why is quantum computing booming now? Well, it's a mix of hype and real milestones. The US finalised the first post-quantum encryption standards, kicking off a security upgrade cycle across banks, tech and government. That's a tangible demand signal even before fully working quantum machines arrive. On the corporate side, you've got steady drumbeats, IonQ's deal-making and partnership with Microsoft, D-Wave's latest prints showing triple-digit revenue growth. Of course, it starts off at a small base, but growing revenue is a clear sign that customers are paying for quantum-linked services today. On the other hand, you can't ignore the risks. For now, pure players are still burning cash, and critics say that really the technology is still more than a decade away. McKinsey says that quantum market could approach $100 billion within a decade if today's trajectory holds, spanning computing, sensing and secure communications. Well, certainly keep watching the key players, Rigetti, D-Wave, IonQ for momentum, and more traditional players like IBM and Hewlett-Packard for steadier exposure as they keep playing an important role in this space. So where do things really stand in quantum computing? The CEO of Rigetti himself shared what he thinks is the state of play for the technology. He spoke with our executive editor, Brian Sozzi, last week.
So what we believe is that we are still roughly 3 to 5 years away from a critical milestone for the whole industry that we call quantum advantage. That's when really quantum computers are superior over classical computers for any practical applications in terms of performance or cost. That's really when data centers start buying quantum computers for practical workloads, if you will. So to get to that 3 to 5 year milestone, we believe we need to get to roughly 1,000 qubits or higher. We need to get to 99.9% 2-qubit gate fidelity. We also said we need faster than 50 nanosecond gate speed and some form of error correction. So all of us are trying to get to quantum advantage. That's really when quantum computing takes off in a commercial way. So the biggest challenge for us is the 2-qubit gate fidelity. As I said, right now we are at that 99.5% level. We need to get to 99.9, which means improvement in errors by a factor of 5 from where we are today. But also increasing qubit count from roughly the 36 and 84 qubit level that we are at right now to the 1000 qubit level. Now, that's the area where we have made the big stride in demonstrating chiplets. With chiplets, we believe it's going to be a lot easier to scale up to 1000 qubits. But the fidelity challenge continues. So that is our number one challenge, is to get the fidelity to 99.9%, along with the other metrics that we need to improve.
Elon Musk recently made some, I think it was a post on X, sounding a little bit skeptical on the future of quantum computing, but he's not alone. You know this, Subodh. I mean, there's a lot of quantum computing skeptics out there. What are they missing, and why do we need quantum computing in our lives over the next decade?
Well, I mean, those of us who have been in quantum computing for a while, we remind everyone that nature has demonstrated a perfect quantum computer to all of us, and that's the human brain. So it's not like quantum computers don't exist. They do. We all live with them. Our job is to get a machine, get close to it. Skeptics have been around, and they will continue to be around. Honestly, of many years, 5 years or more ago, when I was part of the semiconductor industry, I was part of the skeptical crew too, because intrinsically it is a complex technology. This whole concept of superposition and entanglement is complicated to understand. It's hard to do something when you don't see it or cannot experience it, and quantum is one of those things. Anytime you try to measure something in quantum state, it goes to a natural state. So there's good reasons for skepticism, and that they will continue. Having said that, I mean, you look at the progress, and we have deployed several systems. Some of our peer companies have deployed several systems. So you can do your standard computing with quantum computers. You can already see that it's working. What we haven't demonstrated yet is to demonstrate that quantum computing is superior to conventional computing.
If we can quickly move on to the Asian markets, and again, a sea of green in Asia, the likes of SK Hynix and Samsung Electronics doing particularly well. Look at the Kospi up over 3%, lifted by those two stocks in particular. The SK Hynix is up over 4.5% today. All right, let's move on to Europe, and it's more of the same. Technology stocks leading the way here as well. Also, all that news about the potential end to the government shutdown lifting the mood in Europe too. And let's have a quick look at where Wall Street will open, and it's looking again like a sea of green here as well. Okay, that is it for Market Sunrise. Stay tuned to Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. I'm Ramzan Karmali. Go own the morning.